This is going to be mostly dividend supported. So if you're overfunding the contract, adding paid up additions, this is typically a zero out-of-pocket cost. Now, if you're not buying paid up additions, then there is going to be a cost to it, but it's still very affordable. And the way it kind of works is, we'll have our base coverage. That's our guaranteed life insurance that we're purchasing. And then we will have our 1-year term insurance on top of that. But then as we have dividends buying new paid up additions, that death benefit is increasing. So we need to buy less and less 1-year term. So the 1-year term obviously is repricing every year, but that price is going to be going up and up every year the client gets older, but we're buying less and less of 1-year term every year. So it keeps that cost in check throughout the life of the contract. And then eventually the 1-year term, we no longer need it and it would actually fall off the policy. So you can kind of see that here on this illustration page. You'll see we started off with $400,000 of 1-year term, but then as we need less and less of it, it's getting more and more expensive, but we're buying less and less of it until eventually the term would fall off because we've had enough paid up additions death benefit to overcome the $400,000 of 1-year term insurance. Stop there. Does that make sense? I mean, there's other companies with similar riders to this. I think we actually stole this from Guardian, but I love this rider as well. It's a great way to either add extra death benefit to a policy at a very low cost, and it's basically permanent term insurance, or a way to buy term insurance and to avoid MEC with overfunding a contract. The second term rider we have is going to be your basic term rider. So this is our premier term with no policy fee. So it actually avoids your client. So if you buy a whole life policy and bought a standalone term policy, there's actually an $85 policy fee. But if we add the same insured term rider on top of the whole life policy, then it actually loses that $85 fee. So a little bit more cost efficient. That is convertible. It follows the same convertible rules for the premier term. And this we allow up to 10 times the death benefit. So when Felicia, when you're talking about putting large dump-ins into a policy, we need to add this term rider to it to keep it out of MEC status.
Okay. So we just add this to the dump. What if somebody does like a temp pay? Would this be good to do that also with the temp pay?
Yeah. I mean, if you're overfunding the contract, if you're adding paid up additions, sometimes we will need this instead of our 1-year term rider term insurance.
Okay.
So I really like using this for, we know exactly what the premium is going to be. It's guaranteed, and it really allows a lot more death benefit, so we can put a lot more cash into it. That's what I would say this is typically used for.
What is how you do the what you showed before, where you have that whole life policy, but you have that 1-year term? Like, what do you call it to get approved, like the underwriting for that, being that there's a term kind of connected with the whole life?
Yeah, so when we look at our total amount to underwrite, that term is going to be added into that. So and I'll kind of cover underwriting real quick. Well, let me get through this real quick, and then I'll cover underwriting and how that kind of works, and I'll try to get through this quickly. So in this issue, we're dumping in $75,000 into the policy, so we needed to add the term insurance on there, and it's a guaranteed premium of $1,593. And this is not dividend dependent. This is always going to be paid out of pocket. Paid up addition riders, we have 2. One will help accelerate the death benefit and the cash value from year 1. The second one helps accelerate more the cash value. And this must include that EBIR term policy that I was talking about, the 1-year renewable term. You have to include it if you had that rider on there. Yeah, I'm going to go over that. I'll skip that part just because it's a little bit confusing on how EBIR and the blend accelerator and the non-blend accelerator work. It's not too important to know right at this point. I would say it just kind of, it doesn't really make a big difference on which PUA rider you use. Now, something that also stands out in our company, we have probably, we're tied, I guess you would say, for the most flexible PUA rider in the industry. And what we allow is a minimum paid up addition of 120 a year, and then a maximum paid up additions of 3 times the base premium. So if I'm paying, $10,000 a year, I could put $30,000 a year in paid up additions. And what we allow is the clients, as long as they're paying $120 a year in paid up additions, they can go from that minimum of 120 all the way up to that maximum of this example of 30,000, back down up as much as they want. We will never put a restriction on how much paid up additions they can put into the policy besides that 3 times base premium. So it's very flexible for business owners, that might want to overfund a contract, but then they have a bad business year. They got to pull back what they can put into the policy. Then they can go right back, the next year they have another good year, they can go right back up to pushing that up amount. And then kind of to your point, Felicia, we allow 10 times the base premium or $100,000, whichever is greater in the first year. So you can have a $5,000 base premium, and we can dump in $100,000 that very first year and really be able to, start that compound growth of cash value. Does that make sense for everyone?
Kind of.
Oh, sorry, Felicia, do you have a question or did you?
I was just responding. I said kind of.
What's confusing you?
Just trying to process everything. It's a lot.
Listen, I've thrown a lot of information at you guys. I do not expect you to remember any of this. Hopefully a little sticks. But if not, I do not expect you to remember. Please come back with questions. I'm happy to talk to you guys one-on-one as well.